Hi everybody, welcome back to the swing trading course. Now we're going to talk a little bit about technical analysis. As you know, we're going to take certain technical techniques, combine them with different fundamental aspects to create strategies. So let's put another building block together right here with technical analysis. And what is technical analysis? It's really a pattern recognition game, the ability to recognize different shapes. It tells us when to enter and when to exit the trade, and can give some very reliable signals. But you know, a lot of people misread the charts. They see things that aren't there, or they're not really picky enough about looking at different charts with technical analysis. Let's see what some of the things that we need to understand. Of course, we're using fundamentals to determine which stocks to buy and sell before we even get to the charts. And then when we want to know exactly what price to pay, where to put our stop, where to put our target, that's where the technicals are going to help us. So using those two forces together, that's what's really going to shape our trading going forward. We're going to start it out nice and easy with some basic pattern analysis. And you may know some of these patterns and you may recognize them, but I'm going to show you how some people misuse them and misread them. You can really hurt yourself with this stuff if you don't really understand how to use it, or if you understand certain aspects but not all of it. And we're just going to look at some very basic things here. We're going to look at a head and shoulders pattern. We're going to look at a double top and double bottom pattern, and we're going to look at the ascending and descending triangles. Every one of these has a bullish side and a bearish side, as you'll see in just a minute. Now we're going to begin with the head and shoulders pattern. This is probably the most famous, the most important pattern in all of technical analysis. It's a reversal pattern. The price rises to a peak and then declines. Then it rises to a higher peak. Now at this point, it's just an uptrend with higher highs. But a funny thing happens. The price comes down to the same low, or approximately the same low, as the prior low. One more peak is made, the right shoulder, a lower peak, and then for the third time we come down to the support level. That support is called the neckline, and that neckline is the key for how we're going to use this pattern. The first thing I want you to realize when you look at this chart is not the shape itself of the head and shoulders, but what occurred prior to the formation of the head and shoulders. Look at the trend. Look at the direction of the chart. Okay? Head and shoulders is a reversal pattern. But the biggest mistake that people make is this. You can't have a reversal pattern unless you have something to reverse in the first place. There has to be a trend that's ongoing that needs to be reversed. And the stronger that trend is, the more wicked and violent that reversal tends to be. So here you see a very strong uptrend and then the formation of the head and shoulders pattern. If you don't see that trend prior to the formation of the pattern, then the pattern itself, the shape itself, loses its meaning. Now, there's always an equal and opposite in technical analysis. The opposite of the head and shoulders pattern, which is bearish, is the inverted head and shoulders pattern, which is bullish. Again, look what happens prior to the formation of the shape of the pattern, and you'll see that there's a sharp downward movement. Okay? Then comes the inverted head and shoulders, which is a reversal pattern. So you have to have something to reverse. Now, you'll notice in this case, unlike the prior example, our inverted head and shoulders, it's not perfectly symmetrical, and the neckline is not perfectly flat. I wanted to demonstrate to you that they don't always look completely symmetrical with nice flat necklines. Sometimes the necklines are slanted, sometimes the shoulders don't quite match up, and that's where the tricky part of the pattern recognition game is, to be able to spot those anyway. But here you see, again, it's a very bullish pattern. We come up to that resistance level, which is the neckline, and once it breaks above that level, the price is going to move higher. Now let's talk about a double top pattern. This is a bearish reversal pattern. The price reaches a peak and pulls back. So far, you're still in an uptrend. The price rallies to a similar price and pulls back again. Now we've got trouble. And you also have a support level underneath those two peaks that is similar to the neckline, and we're going to use it in a similar fashion to the way we're going to use the neckline in the Head and Shoulders. But it's a bearish pattern, and once that support breaks, we're going to sell short. So here you see the double top. Again, look what happens prior to the shape of the pattern. The most important thing that I can tell you, the shape itself means nothing unless there's something that occurs before it that is reversible. So here you have a big uptrend and then a reversal pattern. And you can see we came to the same peak twice, or approximately the same peak. It doesn't have to be perfect. And once the price breaks that low in between those two peaks, then it's breakdown city. In the case of a double bottom, the exact opposite is also true. You need a sharp move downward because you need to reverse something. You need something to reverse. Then the double bottom pattern forms. In between those two bottoms, you're going to see a resistance level. Once that resistance level breaks, it's time to get long. And last we're going to talk about is the ascending and descending triangles. Now, Head and Shoulders and double top, double bottom, those are reversal patterns. You see a trend going one way, and then that double top forms or that Head and Shoulders forms, and you're going to reverse. Ascending triangle is a continuation pattern, but very similar in one sense to Head and Shoulders and double top. You must have an existing trend to be continued before this continuation pattern can really have meaning. In the case of an ascending triangle, we have horizontal resistance and ascending support. The buyers are stepping in at higher and higher levels. The sellers are just trying to hang on to resistance. Once that resistance level breaks, it's off to the races. And in this case, right, we're going to use as the target the widest distance of the pattern. We're going to get into targets and stops and entries in just a minute. In the case of the descending triangle, it is also a continuation pattern, but you must have that downtrend first, right? A descending triangle only makes sense in a downtrend. It is a continuation of that downtrend, so very often that downtrend will pause and form this particular shape before it resumes downward. That trend must already exist before it can be continued, and we have, in this case, we have flat support and descending resistance, and it's going to look something like this. It's a very bearish pattern. I've used it on intraday charts as well as daily charts. Since we're swing trading, we're going to be focusing on the daily charts during this course. But we're not simply going to look at these shapes. We're going to also look at ways to trade them coming up next.